Bitcoin and your portfolio's Bitcoin right for you. How does Bitcoin fit into your portfolio? It's been an active week in the US regulatory space for such a short week. The CEO of Binance resigned along with a $4 billion settlement with the Department of Justice. The Securities and Exchange Commission sued Kraken for operating as an unregistered exchange. And Bittrex Global announced its closure. The battle for regulatory clarity seems to be in full swing, as Bitcoin has reached the status of the 11th largest global financial asset by market capitalization. We will try to find out if there is a place for Bitcoin in your portfolio. Bitcoin is a high-risk asset with potentially high returns that has a low correlation with stocks. Therefore, we believe that the optimal portfolio for many investors should include a moderate share of Bitcoin. Bitcoin is both a technological marvel and a large, liquid investment asset, and while the public blockchain technology can be difficult to understand due to its highly technical nature, the role that Bitcoin and other cryptocurrencies can play in a portfolio is fairly straightforward. Crypto markets offer potential high-risk, high-return assets that do not have a close correlation to equities over a 5-year time horizon, and therefore can be useful components for risk-tolerant investors in building an optimal portfolio. Creating a diversified portfolio with attractive returns is becoming increasingly difficult. A classic 60/40 stocks and bonds portfolio will struggle to deliver returns comparable to the last 40 years. We believe that there is simply no room for valuations to rise. Equity multiples are already high, and the secular bull market in bonds is overdue to the bottoming out of consumer price inflation. Stocks and bonds have also become more correlated, so investors get less diversification benefit from combining them. Opportunities in the public markets are also diminishing compared to the 1990s. There are fewer IPOs and the number of listed companies has fallen by about 30%. To improve the risk-return trade-off of portfolios, investors are reallocating funds to asset classes that provide better risk-adjusted returns, lower correlation, or a combination of both. For example, in recent years, some investors have increased their exposure to alternative assets, including illiquid private assets such as private equity and real estate. While this approach has proven successful, these types of instruments are not accessible to many individual investors. Crypto assets offer something truly differentiated. From an asset allocation perspective, Bitcoin and other digital assets significantly broaden the risk-return profile available to investors in the open market. Bitcoin and other cryptocurrencies, such as Ethereum, have high volatility and should be considered high risk. However, over time, they generate returns commensurate with their risk profile. In other words, although Bitcoin has high volatility, its return to volatility ratio is generally similar to other asset classes. Therefore, adding cryptocurrencies to a portfolio can be seen as taking on additional investment risk in exchange for higher potential returns. Investors may consider substituting crypto assets with other high-risk, high-return assets, such as technology stocks, non-US equities, or some illiquid private equity, to improve portfolio performance. Although the cryptocurrency class has demonstrated high historical returns, it is not highly correlated with other risky assets. For example, over the past 5 years, the correlation between Bitcoin and the S&P 500 was only 40%, compared to the 90% correlation between the Nasdaq 100 and the S&P 500. The lower correlation with stocks means that cryptocurrencies in a portfolio should provide more diversification than some other risky assets. Cryptocurrencies are a young and emerging asset class and should be considered relatively high risk. Bitcoin and other cryptocurrencies may not be suitable for investors with defined capital needs in the relatively near future, e.g., within the next 3 to 5 years. Savings intended for future expenses, such as college tuition or a home purchase, should not include cryptocurrencies. Finally, investors who prefer income from assets should consider alternative options. However, for investors with a relatively high risk tolerance, cryptocurrencies greatly expand the risk-return opportunities available in public markets due to the high return potential of these assets and their low correlation with other risky assets. An optimal portfolio for many investors should include a moderate share of cryptocurrencies.